Major funding for this program is made possible by grants from Bank of America, Merrill Lynch, and Perfect Building Maintenance, Kilroy Architectural Windows, Inc., New York's window company, New York Community Bank, Capital One Bank, Greenberg Traurig, LLP. Additional funding is provided by grants from Briarwood Organization, Beechwood Organization, C.B. Richard Ellis, Cushman and Wakefield, Dime Savings Bank of Williamsburg, Hal Fettner, Durst Fettner Residential, First American Title Insurance Company of New York, Friedman, LLP, Gemini Real Estate Advisors, LLC, Jack Jaffa and Associates, Real Estate Consultants, James D. Kuhn Real Estate Institute at Syracuse University, Madison Realty Capital, Massey Knackle Realty Services, Markham LLP, Marcus and Millichap, Margolin Weiner and Evans LLP, M&T Bank, Meridian Capital Group, the Moynihan Group, Newmark Knight Frank, Orphanides and Associates, SJP Properties, Sterling and Sterling, Stonehenge Partners, Urban American, the Wickoff Group.
Hello, my name is Michael Stoller. So we're in the spring of 2010. The Dow is over 11,000. The S&P is over 1,200. And certain people think that the world is turned around. No more recession, the world's great, everything's wonderful, But I don't know. I'm not sure. And I really brought together today 4 individuals, senior professionals in the accounting profession who have seen different cycles, who've seen a lot of things over their lifetime. And I want their perspective on what the world is today and what they can project for 2010 and 2011. My guests today include Jeffrey Levine, real estate partner at the firm of Margolin, Weiner and Evans, LLP. Paul Koenigsberg, senior partner at Koenigsberg Wolf. Ronnie Conigliaro, senior partner and head of the real estate practice at Markham, LLP. Right. And last but not least, a returnee, just like Mr. Levine on my other side, Jay Goldstein, senior partner and head of the real estate practice at Friedman, LLP. Now, I got guys sitting here who've been in the business 30, 40, 45 years.
You have to remind us?
No, who've been 50, okay? No. And have seen cycles. So are we in a better place today? I mean, I still am surprised by the recent trades, that there's more money out there. People call me the Grim Reaper. So what do you think?
Well, you said better place today. You didn't say than yesterday, than 5 years ago. But let's assume it was
a year ago. A year ago, 6 months ago.
Definitely better. Doesn't mean it's great. A year ago, it was Chicken Little, the sky is falling, the sky is falling. Well, maybe the sky did fall, maybe it didn't, and we're here where we are. I truly believe the commercial market in New York has bottomed out or near bottomed. The problem, as we had 20 years ago, are our lenders, but it's a different breed. The mezz lenders are the frightening ones, because these are real estate players.
We'll get to that in a second. Paul? You've represented entrepreneurs, you've been involved with companies that have gone public, you've been on boards of publicly held companies who are involved with the real estate business. How do you see it?
Well, I'm not too sure it's bottomed out because I don't have that kind of recent knowledge. I do believe it might be slightly getting better because you're watching the REITs getting stronger. There seems to be more money on the street. However, from my perspective, we have a very long way to go yet. The clients that I represent, as I stated, some of them have done all right simply because their debt was always in line. Others are struggling today if we're talking the real estate business. The apparel industry is still a major struggle. And if you want to leave this city and not just hone yourself here, there's major issues throughout the country. So I'm not too sure we've bottomed out yet, and I'm not too sure where we're going to go from here, quite honestly.
Ronnie.
I agree. I think that we probably haven't seen bottom yet, and I'm not as optimistic about the recovery. The economic indicators are still not there. The unemployment is still at a very high level, close to 10%, 9.6% nationwide. The credit in the marketplace is still not there. We still have federal deficits and state deficits that are not resolved at this point.
We're printing more money, printing money,
Yeah.
having the games with the $8,000 tax credit, we don't know what's going to happen. April 30th, it didn't affect a lot of things in New York City, but it didn't really improve anything.
No, I don't see that as a stimulus that's going to have a long-term effect. I do think that rents are still coming down, and we still have vacancy rates increasing. So it's a ways to go.
Jay.
I think you almost have two markets. Manhattan, despite the fact there's been a tremendous depreciation in values and also in rents, has now reached a trough. And my concern, like the stock market, that we're not going to have a double-dipped recession. And people have been pretty quiet about that from in the last 6 or 8 months. They really haven't spoken too much about it, but that's my concern. I think 11,000 Dow Jones index is really a little bit unrealistic, but I'm not an economist. And I'm just waiting for the other shoe to drop, and I think as commercial real estate, which is a big part of the economy, starts to rear its ugly head, the mortgages and so on, I think there are going to be continuing problems. And I look at this like an L-shaped sort of recession, which is not what we're used to. We're used to sort of a V or a U, and when you have an L, this L, the long part of it, may start to become longer than the top part. So.
Prior to the show, we were talking, and Paul, which I'm going to ask Paul to comment, but last year I was in Washington for a meeting of a small think tank of real estate people. And we had a very bright guy from the Heritage Foundation, and the person said, we are going to have a recovery, and then we're going to have a worse dip than you expect. You said before that you heard that J.P. Morgan said that 2010...
Yeah, it was out, and then one of my friends just mentioned it today. They were at a meeting, was good and bad. The good part about it is J.P. Morgan Chase is very strong believing because of this year, a lot of cash with major corporations. There'll be some hiring. They have to disperse their cash some way, so that things should be all right at this time. But their belief is 11 is going to be a massive change. All of the stimulus packages will be over. There'll be, as we know, major increases in taxes, as there already are for us in New York City, and it's going to get worse under the Obama plan, not commenting on the plan itself, commenting on the amount of taxes that we're going to have to pay. So I'm not really sure where any of this is going, and maybe it's an accountant's thing, but I've been pessimistic all my life. There's no reason I'm going to change today.
Let's go pessimistic and let's go back, let's go back 18 years ago. And I think we were talking about, in the mid-90s, many of your friends and clients and people that you know, some of your good clients, became REITs. They became REITs. And I'm going to ask you why, but you said you were talking, or you were at this NAREIT. NAREIT is the National Association of Real Estate Investment Trusts. And you were there, what, 15 years ago?
No, it's about 19 years ago down in New Orleans, and they had the biggest turnout they had ever had. And the man standing on the podium says, this is the largest turnout we've ever had. And I predict that within 6 months, 50% of you will be filing, either to become a REIT or Chapter 11. And the REIT phenomenon, because we had a few clients that went that route.
Now,
both routes, as a matter of fact.
So let's take the route that went to the REIT. Are those REITs still around as REITs?
No.
What happened?
Clients that we represent are entrepreneurs, they're not institutions. The entrepreneur must get through his head. It's not his business anymore. And the constraints that are put in the public sector are not used. Just don't work with the guy that wants to wheel and deal. One of our clients made a very good move. He went out and he hired professional management within the REIT. and then complained that the man couldn't get anything done. Well, but he was working on a corporate governance basis. And then we de-REITed it about 2 years later.
So, Ron, you have clients today who want to become REITs.
Yes.
Why?
Well, it's a great opportunity for access to capital. And if you have a very good company that has a great management team and has great back office, there's Bank of America, for example, Merrill Lynch are last year, I think, completed more than a dozen REITs. And it's a great opportunity to, again, raise money, deal with the estate planning. It's very tax efficient. But the main reason, I guess, is to take advantage of the opportunity today where the money is available. So, and when this market does turn around, these companies will have cash available to make this opportunistic investments and perhaps to repay some debt.
Now, in the 90s, you represented a company who did become a REIT, and they became a very successful REIT. Why do you think they became as successful as opposed to Jeff's client, who really couldn't live this way?
You know, they hired excellent management, actually, who understood the real estate market. The people that run it today are superb. They're young, you know, they're ambitious, and they have a pulse on the market, and they've obviously have grown. Also, they got great help from the financing world at the time, the brokerage houses, which helped them to increase their asset base. And I'm sure they, as we know, everyone ran on hard times, but they seem to have figured it out and are growing again. So I think it's going to be fine. Also for them. Also, I find, as I mentioned to you, as I read in the paper the other day, talking about where we were talking here, also talking about, is that there are a lot of these people that might either become REITs by getting financing from the Morgan Stanleys, J.P. Morgan Chases in this world, who can raise the money and help them pay down debt, and therefore continue to survive going forward. So I think there's going to be a good market for that world.
We had a client in the mid-90s, this is all public record, bought by Vornado, and that was a fabulously successful deal for both ends, both Vornado and our client. The wonderful thing, I think, that you get out of becoming a REIT and living with it, if you can get the management team and you understand that you're not owning the company anymore from the entrepreneurial point of view, is that most REITs, if they're well run, they don't have to concern themselves as much as an independent developer relative to the cycles in real estate, because they have the avenue to raise money in the public market. And again, if they're a well-run REIT, they can make decisions based upon floating stock or floating debt issues, whereas an entrepreneur
REITs last year's raised over $21 billion last year.
And they have a lot of that money.
They have a lot of the money. Jeff, you were saying before about mezzanine lenders. The mezzanine lenders of 2009 and 2010 are different than the mezzanine lenders of past. What do you mean by that?
20 years ago, for the most part, there weren't mezz lenders. Over the last 6 to 10 years, everybody's using 5% equity and 95% debt, and we have mezz lenders. Those things are trading now, where the mezz lender might have been the realtor, and now if he wasn't a realtor, realtors are buying that mezz debt and they're looking to own the property. You go back 20 years ago, you just dealt with the bank for the most part. You didn't have a CMBS issue, and you didn't have a mezz lender, standing over there with that big hatchet trying to get it. That is going to be the change this time around.
With regard to that, I mean, Paul, you're involved with a company, people know it's SL Green, and they've taken back, because they've been in the mezz position, they've taken back 100 Church. They're trying to take back right now 510 Madison, and they're one example. The Canadians, which was SITQ, took back because they had the mezz loan on 1330 Avenue of the Americas, which is working out. And you have clients, Normandy and others, who have also have used the mezz to own the real estate, right?
Yes. And one of our clients recently, RXR Realty, just to answer your question back, add something to it. I think the mezzanine lenders today are a little different because they're property managers as well. they've got the depth to make not only make the investment loan, but to deal with the property in a foreclosure. And recently RXR, who has a very large management company, which was formerly a publicly traded company, had a mezzanine loan with 32 suburban properties owned by CLK, and they struck a deal where they're going to convert and manage the properties and eventually take over the underlying properties, which is a win-win for the company and a.
You know, an interesting point, and it's perfect for the accountant sitting here. Many people have tried to, you know, because right now, you know, there's this pretend and extend in financing, and there's the restructuring of debt. Very few people truly understand the tax ramifications of the restructuring. How often, I mean, and it happens. I mean, there's a difference in basis, you have to adjust. What are you seeing over there?
Well, it's a difficult situation. There are answers, and a lot of it has to do with knowing and understanding the related party rules and how to restructure the debt so that there is no gain, and you know, being familiar with these complicated code sections that we've all worked with, the 704 section, so that you don't realize profits, unintended profits. But sometimes it happens, and you have to deal with it. But if you're able to have good representation, such as in this room, we can usually figure it out.
What's happening with your clients who have to refinance? I mean, the REITs are the strongest because they have the money, you know, because they've raised the money in the public market. What's happening to the other ones? I mean, the private families, the undercapitalized people, what's happening to them? Jeff?
It's a struggle. It's a struggle. It depends upon when their initial financing came up. Is it 3 years ago? Is it 4 years ago? Is it 10 years ago? We recently had a major office building refinance. There was actually 2 of them, and the debt was 7 to 10 years old. It didn't inflate. In years past, you say, okay, I can get 40% more, stick it in my pocket on a tax-deferred basis. Now it's on one of those properties, we got dollar for dollar, had to come up with closing costs, and the other one was retraded a week before closing and capital call time, but the money was there. Lenders realizing they have the upper hand.
But don't you see more capital out there when your clients ask you, aren't they able to get financing a little easier?
Well, they generally bring in a third party lots of times.
So,
And that's how the restructure works.
I mean, who's the third party today? Is it, I don't want to make a joke because it'll be inappropriate. Is it a third party from Europe? Is it a third party from China? Is it a private equity fund?
It's all of those things.
All of those and then some. There's people now that are setting up these distress funds all over the city of New York. I mean, it's not unique. I already have a client that is very seriously involved in that with foreign money, you know, and he's out raising the difference. If he can get it, fine. He'll be in a position to help support the market. To get to your other question on refinancing, I think what's happening, what's going to happen here, it's just the opinion, not because of clients I have, that all the banks are going to have to simply work out a way to refinance their debt in the next few years. I don't know, what's the billions that they mentioned that are coming out?
That was only
I mean,
Trillions.
That come
I
out.
mean,
It's
the
not
banks
billions.
don't want to write
It's
they don't-
3.2 trillion.
Okay, they don't want to write these things off. They just don't. They can't. They can't afford to.
But that's the issue. Where are the bank's financials these days?
Right, who knows
But the interesting situation is that many of the banks who have survived, who are in the survival mode right now, are not writing them off. They are working with the borrowers. Correct. You know, people are not getting, you know, everybody wants to buy distressed debt. And there was a great comment that I had a young guy on my show last year, and he said, buying distressed debt is like looking at a piece of art from a distance. When you get closer, you see all the flaws. And that's the problem, that people think it's easy to buy distressed debt.
There's no product for sale. I mean, that's one of the things I've been hearing. There's absolutely the amount of product that's for sale on distressed debt is rather low. They're not so willing to sell it. Now, maybe the banks or the holders of this debt are playing their own game on financial statements and saying, no, it's worth 90 cents on a dollar. They don't want the reality of it. But we all have clients that somehow are connected with funds from overseas money and private equity. We're going to buy distressed debt. how many transactions have actually been consummated.
So it's distressed that it's a question. You can play the market because the market went up from 6,500 to 11,000, or you can earn next to nothing in your CD, and it's not going to help you take care of your retirement or anything else. So where are your clients who are astute business people who've been around for years? What are they doing with their money?
Very good question. It's kind of complicated. I think people are coming back into the market. They've missed it. Most of my clients missed it. Most of them were nervous. They kept their money in cash or similar or in bonds. Actually, the bond market was reacting very well if people are aware of it, especially the corporate bond market over the last year. And that's where a lot of people put their money, and they really didn't get hurt. They were earning good yields, and the bonds went up. The stock market, look, who knows? I mean, people could put in their money now. As you know, the fools will follow into it, and then it could crash again.
You said before about, one SL Green is a good example. The stock was $7 at $63. Vornado went down to $14 a share. It's over $85. I mean, all of these.
Boston Properties
if you went into the REITs last year at the beginning, 4 to 5 times the amount, and sometimes as much as 12. But we don't know. I mean. So if you were looking at it, somebody comes to you and they said, maybe they're in a different business. They're in a totally different business, which is a lot of your clients, who, I want to buy real estate today. What do you tell them?
Find a partner
Well,
with
we
a
tell
lot of
them
money.
if they're an individual and buy it through a fund, buy a REIT. If they're looking at acquiring, if they don't have experience in acquiring property, find an investment fund that has strong management. Like one of our clients set up 2 funds recently. One for opportunistic investments that has more risk. Another one for core properties, and they're doing exceptionally well recently in raising money for these 2 funds. But they're good operators, and so I would advise our clients who don't have that experience to put the money with strong management.
I just had a client that I don't represent approach the firm. As they're in a successful business, they have money they want to invest. So I went back to my partner and said, all right, how much and what's their appetite? Are they looking to buy office, retail, residential, unsold condos? And what's their personalities? That's the important part.
What's the tolerance level? What do you think?
Well, tolerance for risk is the real key.
I think there's tolerance for
And understanding it.
So if you were looking today in the spring of 2010, what do you think is the best asset class and what's the worst asset class?
Well, on one level, it's counterintuitive. People would run the other way from commercial real estate. But I believe in with the right judgment, the right location, as Harry Helmsley used to say 3 times, location, location, location.
Is it residential? Is it office? I mean, I'm talking, there are different asset classes. People are, the good and the bad is that last year, tourism brought in 46 million people to New York City. The good is New York City was the highest priced place as a business traveler. The bad is that there are 13,000 new rooms opening up this year. That's going to make a little difficulty in the hospitality market.
Right. Residential is notoriously the most stable, certainly in this area. And if you're not faint of heart, you go to a different asset class, like maybe commercial real estate. There are opportunities, I think, in B buildings now. I mean,
in Manhattan, but what about, we were talking before about Long Island, Westchester, New Jersey. Are we sitting shiver, or we're at the wake on those places? What do we have?
Well, going to ask me I think the residential real estate short term is a very good investment. Long term, in the long term, I think the commercial real estate office market is where to put the money. I think the suburban markets like Long Island and Westchester have a ways to go. The vacancy rate is exceptionally high, and the rents are still coming down. So if you can spot a good transaction and acquire low, and it's a buy and hold, and you're going to hold for a while.
With the suburban markets, if you look back over the last 40 or 50 years, as New York goes, so do those markets. They lag us going out of a recession and into a recession. but those are strong markets when Manhattan is strong.
You know, New Jersey, Westchester,
Jersey.
and Long Island have always been $20 to $30. They don't go higher. I mean, as somebody would say, Jersey City, which is some people consider the sixth borough, you may have that. But Roseland, White Plains, Uniondale,
Right.
they're all at the same number. They don't do well.
Yeah, but you're talking about asking rents. Now you have to ask is what's the vacancy rate? And if New York is not doing well, then you have vacancy rates that are in the 20% range.
The same situation. People were moving to lower Manhattan because it was a low-cost alternative. Right. When in Midtown you can have a rent at $40 to $50, why are you going down to lower Manhattan? The subways aren't working, the new transit system isn't there. There's a different question. It's the quality. When it was $90 a square foot and you can go to $40, it would be a different case. You've been in Midtown South. I know it's not. It's
Perfect.
right. You've been in Midtown South for how many years?
Well, let's see now. I'd say 24 years. I started at $10 a foot. I don't think I'm much higher. No, I am. Jeff Smith would get very upset if I said that. But the bottom line is that's how. It was actually, interesting enough, my first move. We were at 200 Madison, and they were jumping to $20 a foot. And Jeff said, come on, I'll take you into the space where I was the only one that spoke English. No insult intended. There were a lot of rag people there. And put us in at $10 a foot, and I've been there for 24 years. I'm paying more now.
Wait. All of the people were in the rag. They were in the carpet and the other business.
Carpet and rag.
And the interesting thing is, now all of them were in the real estate business too.
That's true.
So they've all got.
We were never big believers in having space in high rent areas. It's just a philosophical way we looked at our business.
It's a type of business. So, looking at it, I think there is, with the exception of maybe Mr. Conigliaro, there's a little cautious optimism and a little pessimism, especially with what you heard from J.P. Morgan and some other things, that 2010 might be fair. 2011, we may have some difficulties. Am I correct with?
Well, I wouldn't comment on J.P. Morgan. I'm not an economist,
Okay.
And I wouldn't venture to say how things are going to go, other than the fact that I truly believe we still have many issues in this country, and it's going to take a long time to pull us out.
So I'd like to thank my 4 conciliers, because you're the conciliers to your clients. I'd like to thank Jeff Levine, Margolin, Weiner, and Evans, Paul Koenigsberg Wolf, Ronnie Conigliaro, Markham LLP, and last but definitely not least, Jay Goldstein, Friedman LLP. Next week, we have the residential guys talking about where they see the residential market. See you next week.
Major funding for this program is made possible by grants from Bank of America, Merrill Lynch, and Perfect Building Maintenance, Kilroy Architectural Windows, Inc., New York's window company, New York Community Bank, Capital One Bank, Greenberg Traurig, LLP. Additional funding is provided by grants from Briarwood Organization, Beechwood Organization, C.B. Richard Ellis, Cushman and Wakefield, Dime Savings Bank of Williamsburg, Hal Fettner, Durst Fettner Residential, First American Title Insurance Company of New York, Friedman, LLP, Gemini Real Estate Advisors, LLC, Jack Jaffa and Associates, Real Estate Consultants, James D. Kuhn Real Estate Institute at Syracuse University, Madison Realty Capital, Massey Knackle Realty Services, Markham LLP, Marcus and Millichap, Margolin, Weiner and Evans LLP, M&T Bank, Meridian Capital Group, the Moynihan Group, Newmark Knight Frank, Orphanides and Associates, SJP Properties, Sterling and Sterling, Stonehenge Partners, Urban American, the Wickoff Group.